Eric, sometimes I need to be reminded of just how broad your coverage universe is. You got e-com, digital media, mobility, China tech, gaming. I guess just Uber to start with, your reflections on the quarter.
Yeah, it was a very different narrative than what we heard from companies under my coverage last week, where there was a lot of softening demand, maybe better than feared revenue, but still revenue trajectories that were not moving in the right direction, and a lot of OPEX and CAPEX being spent that left investors scratching their heads last week. The complete opposite happened from Uber this morning. Strong top-line trends, good solid forward commentary on trends moving out to Q4. When given the chance on the earnings call, no red flags being thrown by the management team with respect to the macro impact on the top line, and outsized beats on profitability. This has been the third quarter in a row that Dara Khosrowshahi and the team at Uber have produced a linear narrative around profits against a broader goal of doing $5 billion plus of adjusted EBITDA in 2024 that they first laid out at the Analyst Day in February earlier this year.
So is it an illustration of what we might hear from other travel, I guess, mobility-related names this week?
Well, I think what you're going to hear on the travel side will be strong trends in the September quarter, pretty good visibility into strong trends into December as we've gone out and done industry checks. And I'm sure all of you and folks that are listening have felt this pinch of trying to go in and book a hotel room or an air ticket into the end of this year. It's not a particularly pleasant experience because of where pricing is right now. So travel trends remain good into the end of this year. The problem for travel stocks is as you go into next year, there's a lot of fear among investors that you're going to have a weakening consumer into tougher comps. You're going to be lapping against the elements of the summer travel season we just came out of, and you could see deceleration next year. So travel stocks are unlikely to going to be trading as much on this quarter's narratives as it will against fears or abatement of those fears as we move into the first part of next year.
Eric, good morning. It's Deirdre. If you're looking at the gig economy, the space you cover, why would you want to invest in an Uber versus, say, a DoorDash or an Airbnb, which are a lot more straightforward? I know what you're saying in terms of that improvement from Uber, but there's just so much noise. We noted at the top nearly $9 billion in losses this year because of those equity investments. Airbnb, on the other hand, it's profitable. DoorDash is a little bit easier to understand, too, in terms of those unit economics.
Well, I would say a couple things there. Number one, rate of improvement on profitability is what investors want, and we think Uber's delivering on that. That would be point number one. And number two, we like the diversification of a lot of product mix. Having just one product in a market where there could be more cyclicality than we've become used to in the last couple of years, and where you might have to be positioned easy comps versus tough comps or rate of change in consumer behavior, we like that product diversification or that portfolio strategy that Uber has right now to give a little bit better risk management around some of the nuance you might see in changed consumer behavior going forward, rather than just betting on travel or just betting on food delivery. So those two elements for us leave us with Uber being our top pick in that grouping.